So, Palantir and Tesla to me are two of the best stocks to own, but more importantly, they have been massive money makers so far for many of us, and I believe they will make a lot of money in the future. But yet many retail investors are down or just not seeing the returns that they want, and the reality is most of us retail investors lose money on incredible investments because we do exactly what we are going to discuss today, which will destroy your investments. But hold on, don't worry about it. I'll tell you how to avoid them so you can be the select few who will actually make a lot of money over the long run and not be like all the rest of us retail investors. Now, before we get started here, you guys always ask me for educational videos, and here it is right here. Yes, we're going to talk about Tesla and Palantir specifically as well, but here it is. Probably going to do bad on the algorithm, so please like the video so that it would help out with the algorithm a little bit, but these videos typically do terrible. It's long, but it's going to give you all the tools that you need in order to be successful. So stick around for it. And again, just like it so that way it goes out to some folks, because these videos tend to perform very, very poor. So there are actually 4 core reasons why retail investors statistically, really throughout the history of time, at least since I've been involved in the market and absolutely before the market as well, there's actually 4 core reasons why retail investors consistently lose in the stock market, despite the fact you pull up any chart of the stock market and the market basically just goes up over the long run. So we'll discuss those, plus how to avoid each one so you can be a big winner in the end. So let's start off hot and controversial right here at the beginning with number 1. And that is, you believe the hype. If you believe Palantir is going to be a $500 stock in the next, 3 years, 4 years, 5 years, whatever the case is, or Tesla's going to be at $1,500 in 2 years, or any of those other things that I see and I hear daily out there in this world, you might be buying into hype. I mean, I win if that absolutely happens, but I see no tangible data, no tangible projection that actually makes any of that true. I mean, how many folks out there think Tesla bot's going to take over the world? Despite the fact that there's no actual tangible data for any of this sort of stuff. When you actually look at something like that, where it's a completely new market, it's completely unfounded, nobody's ever done this before, we don't know what the actual market is. We don't know what the actual demand will be. We don't know if Tesla can do it profitably or not. We don't know if it will just be something that's great and it actually is what all the hype says, or if it's something that just goes into Tesla factories and it never really moves beyond that. It's just another robotics thing, like Amazon has their own robots for their factories and so on and so forth. Or is it something that's a complete bust that ends up just costing us a lot of money as investors? And even if they are able to solve it and mass produce it and everything else, is it actually going to be profitable and add a lot to the bottom line in the end? The reality is, for now, every single piece of that pie is a 100% guess. Nobody knows the answer to it. And yes, even great, incredible, game-changing companies with incredible CEOs and, teams full of geniuses and everything else have products that are a bust and they don't go anywhere and they end up just costing the company a lot of money. It happens all the time with all the greatest companies in the world. You can go through, look through their history and see all the projects that they ended up eventually scrapping and that they released and went nowhere, that everybody thought was going to be game changing, and it just wasn't in the end. That is part of the life cycle in a company. You cannot bank on things that are experimental, that are so far into the future that we really don't know whether or not it's going to be a hit or not. That is what's called hype. Whenever you start seeing projections and all these other things out there for it, and you're buying into it, if you start believing and then start trying to price it into the stock today or trying to figure out what you would pay for it or anything else like that. When I look at some of the Palantir projections, future prices for Palantir, they're not getting there at the current growth rate at 20% that Alex gave us, that the CEO told us is going to happen for the next year or two. You need 40%, 50% growth rates to hit some of these projections. And nowhere, even in Alex's most bullish of bullish cases, he's given us 30% at the max. There's no place out there where anything beyond hype is saying 40 or 50% growth rates are going to get us there in regards to those crazy projections. That is simply overhyped Palantir projections. I don't need to look back very far to see exactly where hype gets you. Look back to 2021. Tesla today, and you can go look it up here. You can split adjust it for yourself because obviously Tesla hadn't split then. But you can split adjust it and see there was a lot of bullish YouTubers that had Tesla price targets at 2,000, 2,200, 2,500, sometimes even more than that on their ultra bullish cases and a lot of other things like that. Today, that right there is where they were supposed to be at the end of 2024. But yet here we are, well under $200, nowhere near $2,000. If you bought in 2021 at $400, expecting it to be at $2,000 today, You simply believe the hype and nothing else. I don't need Palantir to trade it at a multiple at 1500, which is the only multiple you can give it in order for it to trade at some of these crazy projections that people have out there for Palantir to be a great gainer for me by 2030 or 2028 or whatever the case is. It's already been a great gainer for me just simply over the past couple of years. I don't need these crazy projections in order to make it a further great gainer in the future. Now, you're right, might not 100x like some of these folks want, but you know what? If by 2030, and I don't like projecting out that far, so I don't have any tangible data to it, but if I look out at 2030 and I've tripled up my money or done something like that, not 100x my money, I'm going to be a really happy investor. I don't need any of those to make a lot of money and have both of those stocks be great investments for myself. So how do you avoid this? Well, guys, this one's going to require a little bit of work and just a little bit of thought process. And you need to just analyze the projections whenever they come across. If they give you numbers that they feel are truly real, truly true, and they're out at 2030 or 10 years into the future, whatever the case is, that is a red flag. You cannot accurately predict stock price movements beyond a year or two based upon the guidance that the company gives us. That's pretty much it. It starts getting real murky by year 3, and by year 5, it is a pure guess. Just, again, nobody had anything that's happened over the past, 5 or 6 years on their bingo card whenever they were looking out projecting the future of the next 5 years in the stock market back in 2019. You just didn't have it. It's impossible to do. So all you can look at from a business standpoint, from a stock standpoint, is just the past couple of years. When you do simple share price appreciation on Palantir, don't trust fancy spreadsheets or crazy DCA models and everything else. Because if you remember back in 2021, when it was up over $40 per share, there was a lot of folks out there, a lot of big YouTubers out there showing you the fancy spreadsheets and the fancy models and all this other stuff, showing you those same exact models they talk about today, showing you that at $40, you're getting a steal on Palantir, despite the fact none of that was true. Alex says 20% for now, so use 20% as your growth rate, and you can extrapolate out a couple of years from that. You don't need crazy spreadsheets, you don't need crazy models or anything else. Anything beyond that, you're getting much more into just pure speculation, and that's exactly how you end up with hype, because of course you want to be bullish, you want to be somewhat, hey, I really enjoy the company, I think they're going to do great things, I think they're going to beat 20%. Okay, great, do 22%, 25%, maybe even 30% like Alex said out there, even though he didn't say that over the next couple of years. But my guess is you still end up with a number that's on a reasonable ballpark in terms of where you're at. Not the crazy projections that I see out there. There are way more unknowns with Robotaxi than there are knowns, and so I don't include it in my projections at all because I would strictly be guessing. But when I see crazy projections and people putting them in there into their spreadsheets, I know I need to just avoid that talk altogether. It's not even a fun exercise for me to even consider at this stage until we get something that's actually tangible. And more importantly, Elon is willing to give actual guidance on the earnings towards it, so that way I can appropriately see how it's going to impact that bottom line. So number 2, you have not done proper due diligence. Do you really know what you own? I mean, if you haven't done days, weeks, hours, obviously, sometimes months it can take for me just to do simple due diligence on a stock. If you haven't done that, but instead you've watched a handful of YouTube videos and, maybe listened to an earnings call, or maybe an earnings recap, you hadn't even listened to the whole call yourself, you just listened to an earnings recap, you have not done due diligence on the stock, which means you don't know what you actually own. When the numbers turn sour like they did for Tesla this year, you're going to know exactly why. Instead of being a little bit worried, instead of questioning your investment, you're going to understand the why behind all of those numbers and exactly what the impact is going to be, more importantly, so you can appropriately adjust your price targets down for that. That is exactly what I did whenever Elon gave us guidance back in October that, hey, it's going to be a rough next year. It was very easy to sit down, do the very simple math on what that means. I immediately adjusted my price targets down because that's actual guidance, something tangible that I can grab a hold of, not hype, not projections, not anything else. That's guidance. And therefore, I was able to pretty accurately move my price targets down. First one to 169.69, and then the second one down to 142.69. And I was able to hit both and add a lot of shares at those prices, and I'm very happy with those buys. And think about it like this. In 2022, when Tesla was falling and falling and falling, and everybody was just bearish on it, regardless of what happens, I was excited as a shareholder. I was not fearful. I was not scared. I was excited. I knew the opportunity I was getting at, right around $100 per share for Tesla. When you do the due diligence, you know exactly what you own, exactly what valuation should be, exactly whether or not you're getting a steal deal or you're getting ripped off, and you get excited, not scared when you get a steal deal. If you don't do proper due diligence, You're going to be excited whenever a hype run happens instead of being cautious like you should be. And then on the flip side, when it's cratering, you're not going to be excited. You're going to be scared instead. Same exact thing applies to Palantir. I can remember when they had the first profitable quarter, it had a big run up after that. I don't remember, it got well over $10 per share. Everybody was excited. And then all of a sudden it started cratering, and all of a sudden people were scared to death. And I was excited as could be because I got one last chance to add a ton of shares in that $7 range before it finally picked up and basically took off on you after that. Proper due diligence allows you to take advantage of the market like that every single time. How do you avoid this mistake? Well, guys, this one's pretty simple. You learn how to do due diligence, and you actually put in the time and take the time in order to work it all the way through. You can learn that right here on YouTube. You can put it right up there in the search bar right here on YouTube and get it out there and get all the information for free. If you want it kind of condensed and kind of put together for you, take a course on it. It doesn't matter how you get it. You absolutely have to get it. Yes, my group has it. If you want to learn how to do diligence, we got it start to finish, got an entire course on that. Of course, all of us can help you out with that and everything else. We got coaching on it. We got everything involved with it, but you have to learn it. It is critical that you learn it. I don't care if you do it or not. Yes, my group's on sale right now. Check out the pinned comment down there. You guys can see everything you get. We got $250 portfolio. We got $15 founder spots as well. I get it. That's not right for everyone. So please take advantage of the sale. Learn it from somebody else. Join somebody else's group. It doesn't matter, but learn how to do due diligence and put in the time and effort in order to learn it. That may be the biggest difference between being a successful investor and an investor who completely fails. But don't ignore these last two. And actually, the last one may be the most important one of all because it can absolutely destroy you. But let's go on to number 3, which is you are emotional about the stocks. And look, there's a lot of different ways you can be emotional about your stocks, but understand, and we'll get into all the different reasons why, but understand emotions are your enemy. Both good emotions and bad emotions, they are all your enemy in the end. And there's a lot of different ways that this manifests into your behavior, into how you think, into how you approach things. All these things come from an emotional state. So let's go through a few examples here. If you feel the need or the urge to defend Elon or Alex whenever they actually do something dumb, then you are viewing this as much more of a relationship than you are actual objectively looking at what a CEO should and shouldn't be saying on an earnings call, on their Twitter account, whatever the case is. You are not connecting as an investor. You have now moved much more beyond that investor state into a completely different category that you don't want to be in. Investors who do that and who get that emotionally invested in any company make mistakes and end up screwing it all up in the end, simply because they cease to be objective anymore. And I'm sorry, Elon is brilliant, but not every move he makes is 4D chess that's going to change the world and make $25 trillion. It's just not. He makes mistakes. He has things that are a bust. He makes decisions that are just bad decisions. That happens to every single CEO. The same exact thing with Alex. Not everything he says has come true. Not everybody has to have his product like he thinks everybody should have to have his product. Yes, Palantir's product is incredible, but the facts are a lot of folks will never even try his product, much less be willing to pay him for his product. There will be future, very real competition for both of these companies here. And guess what? Some of the things that these companies do that they are the best at right now, there's going to be companies that are going to do various parts of it better than what these companies do. Then that doesn't make these companies trash, and it is not a, oh, there's only one winner and everybody else has to lose and everything else like that. I hate that sort of mentality. It's the wrong mentality to have. And more importantly, it just creates emotions, right? It's, oh, it's all or nothing, right? Winner take all. That is absolutely not true in investing at all. But people love to view things that way because, I don't know, for whatever reason, people want emotions. People want to be on one side or the other. And it's just simply not true. The reality is there's going to be folks out there that are going to do things in the EV space better than Tesla. There's going to be folks out there in the AI and data analysis and everything else that Palantir does that are going to do certain parts of it better. That is going to happen sooner or later. And we need to just understand that and not get emotional about it whenever somebody says that. So how do you avoid this? Stay objective and avoid your emotions. Don't even let them creep in. I have never felt the need to vehemently defend a CEO. Now, sure, I get asked about my opinions on CEOs. Sometimes I try to dispel misinformation about a CEO. Absolutely. Or maybe give another side as to why that CEO made that decision or may have said that or whatever the case is. But when a CEO makes a mistake, I point it out and say, yeah, he screwed up. That's not 4D chess. That's just dumb. Yeah, he said this on an earnings call. He should not have said that on an earnings call. Yes, This earnings call was extremely, disheveled and unorganized and not very professional, and that hurts shareholders. Yes, this guy over here absolutely banged the table, and that wasn't necessarily the most professional thing in the world. So I need to keep that in check and stay objective. Emotions cloud your judgment. They cloud you from seeing legitimate issues with a company or with a stock, and they cloud you from making the proper decision when those come up. And the best example I can give was I kept emotions and where I thought Tesla was going out of my feelings whenever I analyzed Tesla at $400 per share back in 2021, and I knew it was crazy overvalued. That is what objectivity told me. Now, my emotion said, dude, this run could keep going. I had no idea that was the top of the run. I mean, for all I know, it could have gone to 450, 500, maybe even further. That's kind of what my emotions told me. But I stayed objective and I didn't let those emotions get in the way. And I knew, hey, I need to stay away from this. It's going to come back down. Objectively, what's going to happen? Well, whenever the run stops, and it finally will stop, it's going to trade down or flat for a period of years. And the further up it goes, the longer that flat and downward trend is going to be on the other side. Never use emotions to make those decisions. Let things like valuation guide your decision making. And finally, number 4, you listen to the noise and may not know it. This applies to both bull and bears all the way across the board in regards to noise. A lot of us think we don't listen to it, but then we make decisions and we have feelings like we just talked about, emotions, and a lot of other things that are absolutely 100% dictated by the things that we take in where we feel like we're gathering more information. Maybe we're doing due diligence, which that's not due diligence at all, a different argument for a different time. But nonetheless, you are not avoiding the noise. You are listening to the noise. And just because it's positive doesn't mean it's not noise. And if it's negative, it's noise. No, it works both ways. How many YouTubers, and there was a lot of them, guys, because we were tracking them in the group. How many YouTubers in 2021 were all in on Tesla at those ridiculous highs and then completely flipped in 2022 and turned bearish and sold out and kept giving lower and lower price targets well below $100 for the stock itself? How many YouTubers were bullish on Palantir at $30, $40 back in 2021, but then completely flipped in 2022 when Alex banged the table and some of them sold completely out of their positions or they got very bearish on the stock instead of telling you to pile in at those prices? And again, I'm talking about bulls here. And if you listen to those bulls, you absolutely ended up buying high and selling low. And unfortunately, that is exactly what retail does over and over and over again. I have seen it for the 25 years I've been investing. I have seen it happen repeatedly to family, friends, coworkers. Everybody that I know has virtually done that repeatedly. And then, of course, they swear off investing after that because it's all a scam, right? It's all rigged. It's all these other things that you hear constantly. And it's not true. Somebody's out there making a lot of money and nobody forced you to buy at those highs. Nobody forced you to sell at those lows. The reality is, if you would have ignored the noise, you probably wouldn't have made either decision. So you don't need anybody's help in regards to doing this sort of stuff. And that includes me. You don't need to listen to me. You don't need to listen to anybody else here on YouTube. You just don't. You got to get out of that. But I see in our community, in my group, and a lot of other places, folks listening to the noise. And that is one of the biggest, if not the biggest mistake that people make. So how do you avoid this? Well, you guys know, you simply ignore the noise. Quit listening to YouTubers, including myself if you need to, and stop paying attention to what we're doing and do your own due diligence first. Do your own work first. When those earnings calls come up, don't immediately run to a reaction video or anything else like that. You notice mine come out usually days or sometimes even further after that because I need to take time to digest it and go through it and kind of make sure that I'm saying the right things that I want to say there about those particular earnings. But you don't need that. Do your own due diligence. If you're not sitting down, listening to those earnings calls, going through all the different financial data that they give you, comparing it to last quarter's financial data and making your own assumptions and your own notes and everything else, if you're doing that sort of stuff, you probably won't even feel a need to actually pull up somebody else's reaction or their thought on earnings or anything else like that. You'll have your own that is set to your plan, your risk tolerance, your goals with that particular stock. I don't know your plan. Nobody else knows your plan, your risk tolerance, your amount of income, what this stock needs to do for you, your need to return, your margin of safety, any of those other things nobody can speak to except for you. So you need to put in your own work and do your own due diligence to understand that and ignore the noise all the way around. And if you want to help learning how to do due diligence to become a competent investor, so you don't need me, you don't need anybody else, join my group, guys. It's on sale right now. A full membership is. We will walk through you. Obviously you can take the course and go through step by step exactly how to do due diligence on a stock. then you can jump on the free coaching, get even more information and fine tune those skills, have us help you out with sticking points as you're working through the course all the way through, and so much more, guys. That's what it's all about in the end. And then, hey, if you want to leave the group and go be a competent investor in your own, that is exactly the design of the group. It is not designed to keep you trapped and keep you dependent upon Luke for Luke's answers and for, oh, Luke, what do I do about this? Oh, Luke, what do I do about that? It's not what the intent of it is. It is intended to be a place where you can come, learn to be a competent investor, and then hopefully you stay so you can have very high level discussions about stocks. And we're not talking about what to do. We're talking about how to maximize opportunities. We're talking about finding hidden gems. We're talking about a lot of other things like that. Not what do I do with this and that and whatever the case is and what stock's going up today or anything else like that. It's not what it's all about. And if that's what you want, I apologize. Not what the group's for. It's about basic investing fundamentals and getting you competent and getting you to that point where you are a successful, confident investor in the end, to where these 4 factors that we talked about, these 4 core things that trip everybody up are absolutely not something that's going to trip you up. That is what the goal of the group is. Check out the pinned comment down there and see if a membership's right for you before the sale ends and the price goes up. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan in this market. So thanks for watching, and we'll see you in the next one.